For more on what the second supersized rate hike could mean for the economy and for the markets, we are joined by former Dallas Fed President Richard Fisher. He's now senior advisor to Barclays. He serves on the boards of Tenet Healthcare and Warner Brothers Discovery and is a CNBC contributor. And Liz Young, who's the head of investment strategy at SoFi. Richard, why don't we start with you? Because the immediate take from a lot of people listening to this, at least a lot of market players listening to this, is that this was a much more dovish Fed. Is that what you heard?
No, but I never go by what the market reacts to immediately. It's a manic depressive medium, and I just got excited because it wasn't as bad as they might have heard. And there's also more confidence, I think, in the second quarter number that's coming forward. By the way, the chairman of the Fed already knew that number. So I'm assuming that's why his comments were positive about the economy. And the one thing I would note, Becky, they're getting away from providing specific guidance for the next meeting. I believe that was a mistake. In the previous press conference, he had reporting on the then meeting saying we're going to have another 75 basis points. He had to reverse that from the 50 to 75 and so on. So what I heard was basically getting away from specific forward guidance, nonetheless indicating they're going to continue this process. And I think it's going to continue for a while, dampen the economy, but there is optimism they can pull this off without creating a serious recession. And that's what I heard from the meeting. It was kind of blah, and that's the way it should be, going back to the way things used to be before, where non-specific guidance is given during the press conference.
Why is that a bad thing, Richard? I thought that was actually a little refreshing. If we're going to be data dependent, then don't advertise. In this case, it would be 2 months in advance. Like, it's a good thing that we're data dependent. Let's wait and see what the numbers are. I can't tell you what we're going to do in 6 to 8 weeks' time.
I agree. And it's not a bad thing. It's the right way to do things. Of course, we're going to see what comes out of Jackson Hole at the end of August. That's where, as you know, they convene. It's where they made that horrible decision model and enacted it on what I call a horses left the barn approach to inflation. That's now dead and buried. But we'll see still what comes out of Jackson Hole in August. And I think that'll be the next market impactful meeting that they have.
Hey, Liz, the market, especially if you were looking at some of the NASDAQ stocks, really reacted as if this was a huge change in stance and that the Fed is not going to be raising rates nearly as rapidly. Is that your take on it? Is that the right market reaction?
So I think yesterday's market reaction was overdone on the positive side. I think we got a little bit too excited that we got that statement behind us, and I won't be surprised if we give some of that back. What I heard from the Fed yesterday was that they are expecting this cycle to cause some below-trend growth and cooling in the labor market. So just to link that to the GDP number that we're going to hear today, I don't think this GDP number is going to be negative, but even if it is, that doesn't change the trajectory of Fed hikes going forward. I did not hear dovish. I did not hear pivot. To me, pivot means moving in a different direction. All I heard from Jerome Powell was that this was an unusually large hike and that there's a decent possibility that we have a smaller hike in September and going forward for the rest of the year, but we're still hiking. And I do think the market should like that because it remains that public enemy number one is inflation. So as long as they're still going to fight that enemy, I think we're in good shape for the second half of the year. But it certainly didn't mean that they're going to stop hiking or that they're going to turn dovish.
Shepard Smith here. Thanks for watching CNBC on YouTube.